What's up, traders? I want to do a quick video on trading vertical spreads, and I want to focus this video on pricing vertical spreads. So the example I'm going to use is in Apple, and I'm going to use the 90.89 strike put spread as my example vertical spread, and this is May 12th. Or May 13th was on Friday, so we're going to use the June 17th expiration, so we're going to give ourselves a month for these options to expire. So if you don't know much about vertical spreads, you might want to check out some other videos, but this one I'm going to focus on pricing vertical spreads. Now what's cool about vertical spreads is that you can convert them easily into something that looks like a sports bet. You can simplify them into, and then there's a little bit of a more complicated component, but you can simplify them into this idea of a sports bet where if they're at the money, then that's kind of like a pick'em. If you're out of the money and you're selling them or buying, if you're selling them out of the money, you're more likely to win. So at that point you're betting on a favorite. And if you're buying them out of the money and you want them to go the price to go down into this area or past, then you're buying an underdog. So from that perspective, you can get a much clearer idea in how much you're risking, how much your reward could be, and trade management and money management. Vertical spreads are very easy to determine that. Also, they're great because they let you bet not necessarily on risk to reward ratio. Your risk reward ratio is in your percentage of success. So if you can be more right often than you're wrong, or more right versus the odds that you're getting from the by buying or selling the spread, you can make money. So if we look at our example, we're going to start off with the 90.89 Apple put spread. We're going to focus on, we're going to sell it. So that means we want it to stay above 90. So you sell the spread and you want it to expire worthless. I particularly enjoy selling spreads because generally I think you want to be short volatility. You want to be selling insurance, not buying insurance. I think that's the way to look at it. If that's the way the options market makers look at it, they're insurance salesmen. And insurance is a good business to be in. So we're going to focus on selling the 90.89 put spread, and we're going to focus on what price we need to get. And one of the things that I think traders need to think about more, especially when it comes to the options world, is that there should always be a price that you're willing to buy an option or an option strategy, and there should always be a price that you're willing to sell, because nothing's 100% unless you have inside information or something. Nothing's 100%, so there should be a risk reward where you're like, okay, where you're willing to buy, and a risk reward where you're willing to sell the exact same option and based on the price. So with a 90.89 put spread, that is a $1 width put spread, so that makes the math easy. So if you don't have any edge, your expectation for whether this put spread that you're going to sell is going to be successful is something like 50-50. Now, if you're taking in like market dynamics or whatever, maybe you're like, okay, it's 53% going to be successful, 47% not, because 53% of the time stocks go up, blah blah blah. But let's take the simple case and say 50-50. So at that point, to break even, excluding commission costs and whatever, you would want to sell this put spread 90.89 for 50 cents in order so you're risking 50 cents in order to make a maximum profit of 50 cents. So it's 1-to-1. So if you have an edge and you're like, okay, if I think it's going to be better than that, I think it's going to bounce and go up, then you're willing to take 50-50. Now, there's a component to this that we're still simplifying, and that is the width of the strike. So what are the odds that it could land in the width of the strike, in between the two strikes? If it lands in between the two strikes, we're either going to be a partial profit break even or partial loss. So what are the odds happening? So one of the ways to look at what the odds are of that happening is to look at the width of the strike, which for Apple is $1, and the volatility of Apple, the stock. So if we look at the volatility, I've graphed the true range here, and it looks like the true range right now is about $2.90. So if we go back here, we can say, okay, the true range is about $2.90. Let me write this down here. $2.90, and the width is $1. So over the course of a month, is it going to? What are the odds that it's going to land between those $2 with a volatility of $2.90? The answer is the odds are very low. So it really depends on how much time is left in the options, etc. But if there's a month left in the options, and the daily move is 3 times the width of the strikes, it's practically zero. So you're going to get very close to 50 cents on the. You should get very close to 50 cents on the dollar. Now, because the stock is already is at 90 right now, it means it doesn't have to move anywhere, and you're making money. Let's say there was a 10% chance that it was going to land in there. It's not with $2.90. It's not going to be, but let's say it was 10%. You would probably have to take half of that and subtract that from the price that you're willing to take. So instead of collecting 50 cents for selling this spread, you're now only going to collect 45 cents, and that's fair because 5 cents of that it's going to be either a break even. It's going to be a break even for you, a partial loss, or a partial profit. But we're going to squish all that together and say, okay, 10% of the time it's going to wash out. So you're going to make money 50% of the time. You're going to break even 10% of the time, and you're going to lose 40% of the time. So half the time you're going to make 50 cents. 10% you're going to make 0, and then 40% you're going to lose 50 cents. So, or you're going to lose whatever you put. So really, it's no longer 50-50. It's now greater than 50-50. Your expectation is greater than 50-50 because there's a 10% chance that you're going to break even. So at that point, you're probably not going to be able to collect 50 cents. You'd like to. That would be great. At that point, you're winning. But it's probably going to be more like 45 cents or something like that. You're risking. Risking your maximum profit is 45 cents, and your maximum loss is then 55 cents. And that's conversely, if you were going to buy this put spread, you would only pay 45 cents, and your reward could possibly be 55 cents because there's a 10% part here where you're not going to make full profit. So so that one of the things that you can do also is if you want to do out of the money, you would again use the daily average true range, and think about multiple. How many daily true ranges is this out? Is it 3? Well, then if it's 3 out, then maybe I'm only going to collect. Maybe I'm only going to be able to collect 20 cents if I sell it. However, if I want to buy that, maybe I only pay 20 cents. So you're going to use multiples of the average true range to decide what price is acceptable. And this is something that you're going to have to calculate and think about in your head a lot when you first start, and then after you do it for a while, you should be able to accurately kind of in your head do the math and kind of know what price you want to get depending on how volatile the stock is. So this is a quick intro in how to price vertical spreads. Hope you enjoy it. God bless, good luck, and good trading.